What's up, y'all? We got a new guy running the Fed. Powell's out, Warsh is in. And if you're thinking, okay, cool, new guy, same job, no big deal, you might want to zoom out for a sec because there is a pretty major philosophy change underway here. For years, the Fed's playbook was pretty simple. Tell the market everything, explain the thinking, paint the picture so clearly that nobody has to guess what happens next. Well, the new approach is say less, smile more, which is an old playbook from Greenspan's time, RIP. Now, here's why you should care even if you've never read a Fed statement in your life. Less guidance from the Fed means more uncertainty in the market, and uncertainty doesn't come without a price. It shows up in lending, rates, and how conservative or aggressive banks and fintechs are getting with credit. So to break this down, I brought in an expert who covers this for a living, Campbell with American Banker. We get into all of it, Greenspan's instincts, the subprime years, what say less really means for banks and fintechs, trying to plan around a Fed that's gone quiet. Check it out. So there's a big change at the Fed. Powell's out, Walsh is in. What are your thoughts with what we've seen so far?
Yeah, so from new Fed chair Kevin Warsh, the mantra has been say less and smile more, if I can sort of borrow a line from Hamilton. He had his first press conference a few weeks ago. He was very cordial. He was sort of engaging. He wasn't really ominous or anything. He had a sort of a welcome air about him, but he repeatedly declined to go into anything that could be perceived as forward guidance. So he didn't want to say anything forward-looking at all. And that is definitely a noteworthy change from what we saw during the Powell years, where typically, even though Powell didn't want to sort of lock in on any one specific course for future policy actions, he would always try to sort of engage with the question being asked in some way and try to, if not say what's going to come next, give some color into what the Fed is thinking now about what just happened, if that makes sense. So sort of tell a story about how the economy has developed. Warsh was very, very controlled, very deliberate, and really stuck to his guns on this idea of, we're not going to say any more than we have to. And I think that's going to be sort of the running theme, at least for the next little while.
Interesting. So Powell was more open with respect to the playbook, kind of some of the internal levers. If this happens, then that will happen, and then we'll kind of react in this way. Whereas Warsh is keeping it more close to the vest, and he doesn't see the Federal Reserve's job being directing markets.
That's right. Yeah, he's taken an approach where he would actually like to have the Fed respond to markets, which is to say, if he sees, the bond market, if yields are moving in a certain direction, indicating traders, market participants are feeling a certain way about inflation, that the Fed is going to react in a way that maybe brings markets back towards what its preference is without directly saying, this is what we're doing. Whereas under Powell, the playbook was really, let's be very clear about what we see developing and take away some of the legwork for markets and take out some of the guesswork where they have to say, oh, what do we think the Fed's going to do? Let's try to anticipate. It's like, no, just listen. We're going to tell you what we're thinking and you follow suit. With Warsh, it's let's sort of have a lighter touch, let markets play out as they will. And then if we need to, then we'll step in.
Got it. So the Fed makes a statement, which you talked about in the article, which is generally, 300 to 400 words. It was cut down to 130. What would you say has been removed from that statement?
Yeah, it's actually, it's been a lot of sort of superfluous language or things that are just sort of truisms, as that's how it was sort of described to me. We believe that price stability is good. Sometimes there'll be nods to things like conflicts abroad, just sort of an acknowledgement of certain conditions that no one's really going to contest. But at the same time, if the Fed, in the past, there was a perception if they sort of cut that language out, they would have to sort of explain why they're no longer saying these things. So it's this weird handcuff situation where, every time the Fed adds something to that official policy statement, they feel like they have to either continue to say it or have an explanation ready for why they didn't say it. So in this case, I think this was a bit of Warsh wiping the slate clean, so to speak, saying, okay, we're going to give the most bare bones message we can. We're going to be very emphatic that we're going to get, price stability back where we want it, which is to say we're going to get inflation back to 2%. And, and that's it. Here's our decision. Here's the vote. Going to get back to 2% and we're done.
It seems like such a great idea to, be very Spartan in the language that you use. What would critics say to this new strategy compared to what Powell did?
Yeah, I think the main criticism, if there's too much of a pullback on communication, we start to get back into kind of an older model of central banking in which the central banker in charge, be it the Fed or another central bank, let their actions in the market dictate what happens and allow the sort of markets to figure that out for themselves. So, which is to say that sometimes you'll probably get to the same endpoint, but you might have a bumpier ride to get there. And I guess the argument is that there's not a very strong reason for not providing that sort of smoothing effect. So you're intentionally creating a scarcer information environment, creating more opportunities for things to kind of go awry. The counter to that counter would be, well, sometimes people hear the Fed's message loud and clear, they react, and then conditions change, and there's a sort of moment of like, okay, if you're the Fed, what do? Do you react how you would in a vacuum, or do you react how you would to sort of stay on the path you've set? So it's about getting locked in is the concern that they're trying to address. And again, like the sort of criticism is, well, you're creating a lot of uncertainty unnecessarily.
Okay, got it. My perspective on this, and I could be totally wrong, I admit that, but it seems like this is going to introduce more conservative decision making in markets. Is that good or bad? Is that an accurate take on things?
Yeah, I think that is a very real possibility that markets have to become a little more conservative. They have to sort of do their own work a bit more because when you have a higher level of confidence about where things are going to go and you feel that there's some sort of mechanism in place that's going to commit the Fed, for instance, to stay the course, you might allow yourself to play things a little bit looser. Whereas if you have to sort of really be buttoned up for whatever comes next, you might become more conservative. And I don't think that that's a bad thing in the sense that you always want financial markets to be acting rationally and doing things deliberately. But at the same time, anytime there is sort of friction, there's a risk. There's a risk that there's some sort of a hiccup, that there is a disconnect. And let's say markets get ahead of the Fed for some reason. Maybe they think for whatever reason that rates are going to go down. And so they start pricing that in. Credit gets easier to come by. Maybe that's good for the near-term business cycle, but then maybe it leads to sort of over-exuberance, making bad loans, et cetera. In the inverse, maybe markets feel like there's going to be an increase in rates. Maybe we need to sort of tamp down on lending, and you have this pullback and a tightening of credit that prevents business from flowing as it should. So whatever happens, like there's risks that come about. So hopefully there is a more conservative approach to avoid that, and you don't see wild swings. But we'll have to see how that plays out in the market.
We'll see. We'll see.
Yeah.
So your article, I'd say it's probably 5 to 10 minute read for most people. You do a good job of covering a pretty big cross section of time of the Fed, which was interesting. I mean, you go back to Alan Greenspan, R.I.P. Big one hundo.
Yes.
Big. Those are some big shoes to fill for anybody, coming in after him.
Yeah, the maestro, as they say.
The maestro. I was reading some of his quotes over the years, and like what a character. But talk to me about the people who you spoke with to help you make sense of these big spans of time with the Fed leadership.
Yeah, so I've got 3 people quoted in the article. 2 of them were former vice chairs of the Federal Open Market Committee. One was Don Cohn, who worked with Alan Greenspan directly.
Oh, wow.
Yeah.
Cool.
Yes. And actually, he was probably one of the closer, members of the board to him at one point in time. So he gave some pretty good perspectives about how Greenspan approached the Fed and how communications evolved under his leadership. Then Alan Blinder, who also was vice chair briefly alongside Greenspan, which just kind of goes to show how long Greenspan was around and in power for. But Blinder was one of the early sort of reform advocates for sort of Fed communication, sort of opening. He favored a more open approach And so I thought he was an important voice to get in this article. And then I also spoke with Jeff Lacker, who is a former uh, Federal Reserve Bank president from the Richmond Reserve Bank. And I think it's important to have that perspective as well, because the Fed has a very unique structure where you have members of the Federal Open Market Committee, the sort of monetary policy board, who are with the board of governors in DC, and then you also have representatives from throughout the system, and those being the sort of reserve bank presidents. So I wanted to talk to a reserve bank president who could kind of give share his views on what it means to have like a robust communication policy, because sometimes individual reserve banks may have different views on how the economy is playing out based on what's going on in their part of the country.
Mm-hmm.
So it's important to know how that might factor into a new communication system.
Makes a lot of sense. That's kind of textbook good journalism. You're getting perspectives from very seasoned. Those are some awesome contacts.
Yeah.
So I think people who listen to this show have a pretty decent handle on what the Fed does. But what's the role of these local regional bankers as it
Mhm.
relates to Warsh and how Warsh's team makes decisions?
Yeah, so it's a really interesting question, and it's sort of evolved over the years. The sort of the short version is that these reserve bank presidents play a direct role in monetary policy because they're one, they have a vote about the rate, the policy decision on a rotating basis. So every year there's a new set of reserve bank presidents that get to cast a vote. There's in total there are 12 reserve banks. There's 5 seats on the FOMC. There are 4 reserve bank presidents. New York is on at all times. Chicago and Cleveland rotate, and then the other 9 reserve banks are on a sort of like a 1 year on, 2 year off rotation. So they are casting votes directly on the policy rate and the statement about that policy. But even if they're not casting a vote, they're still in the room during the sort of every 6-week meeting of the FOMC. So they're all playing a role in crafting not only the policy, but how that policy gets conveyed. And if you have a vote, sometimes you may vote against a statement because you just don't like the verbiage. We saw that a couple months ago with a couple Reserve Bank presidents voting against the last policy statement under Powell, actually, because they said that they wanted like one line removed from the statement, and the rest of the group did. So you see that playing out in a very real way. And again, there are different philosophies about this. Some say it's important to articulate those different views because it shows the market that, hey, like there are a range of possibilities we're considering. Things could go this way or they could go this other way. Some people say, hey, actually, you want to be, as united as you can so that there isn't that kind of that sort of shakiness that may cause one part of the market to do one thing and another part to do something else. So again, different philosophies, and we'll see during Warsh's tenure how accepting he is of dissents and of people expressing different opinions. Obviously, it's a committee, and people are going to vote how they're going to vote. But you've seen different approaches in the past. Some people who are really sort of coalition based and trying to get as many people to vote yes as possible, and you've seen other Fed chairs who seem to be a little more tolerant of dissent, and just they're saying, "Hey, we're going to vote on it. Do what you will." And so, yeah, we'll see what kind of chair Warsh is in that respect.
How politicized do you feel like the Fed is today compared to, other eras?
It's hard to say exactly how it compares to other, chapters of history, because so much of what the Fed does happens behind closed doors. And until recently, we did not really have the same sort of access to some of the Reserve Bank presidents, and
Sure.
certainly governors weren't speaking their minds as freely.
They
So
didn't have Twitter
they
before.
didn't have Twitter. That's right. No 24-hour news cycle. There wasn't an equivalent of whatever cable business channel you watch, sort of setting up a call with, the
Right.
Reserve Bank president in Kansas City, but that might happen today, just because they want to speak their mind. But I would say that outside the institution, you've had a lot of pressure directly from the president. We actually had a decision just this week about the lawsuit involving the president's attempt to fire one of the governors of the Federal Reserve Board. And so that just shows how there is a lot more scrutiny on the institution from the outside. Internally, as far as the politics go, again, it's sort of hard to say. Certainly you've had for a long time boards of governors that are comprised of people appointed by Democrats and Republicans, right? You've got on this board some people who were appointed by Biden, some people were appointed by Trump. Jay Powell himself was originally an Obama appointee. So again, it's like these things span a long time, but they're not partisans in the same way that other, sort of agencies are. They're not really voting to keep a certain constituency happy. So, internally, I'd say that it's probably a little bit status quo. But again, we'll sort of see how that plays out in the months and years ahead. If this is a board that has a lot of dissents, maybe it is actually more fractious and kind of reflecting what's happening on the outside. But for Warsh's first vote, it was unanimous. It was actually the first unanimous vote by the board in several meetings. So maybe it's maybe they're kind of finding common ground more so than the outsiders would have expected.
So, Kyle, let me ask you about Warsh's relationship with Trump. I think he famously said, "I'm not going to be a sock puppet for Trump." But is Warsh a reliable person for Trump? I think is how Trump might phrase that.
Yeah. Is there a loyalty test involved? That's hard to say. What I think is clear is that we saw, in his first meeting and first press conference, that he wasn't just going to immediately, go in the direction that Trump wanted, which was, towards lower rates. He is going to be, he's going to react to the conditions around him. If we get into a situation where things are a little bit more marginal, I mean, just as context, his first meeting, inflation had been on the rise for the past, I think, 3 months, and it's well above the Fed's target. Job market seems to be rock solid. So when you think about how a Fed looks at the economy, they're looking at two sides. They've got price stability, which is inflation. They've got, full employment, which is, the unemployment rate. Unemployment rate has stayed where it's at. Inflation's going up. So the response is usually to have a bias toward, more restrictive policy, higher rates. Warsh he didn't necessarily say that that's what the direction he was going to move in, because he gave no sort of indication one way or the other. But the fact that he came in and sort of said, we're going to follow the data, I'm going to allow the other members of the committee to express their opinions, which showed a bias toward raising interest rates. That shows that there is independence there. So I don't believe he's going to just be a straight vote for Trump's agenda. We saw that with Stephen Mirren, who was on the board on a sort of interim basis, not interim basis, on a short-term basis. He came in and really advocated for lowering rates right off the bat and voted pretty much every time in that direction. So he's not going to be that kind of FOMC member. But again, we'll have to sort of wait until we get into an environment where things are a little bit more marginal, where could go one way, could go the other, and see if maybe some of the views expressed by the president end up getting reflected in the vote, whatever that may be. But for now, I don't see a reason to believe that he's not going to approach the job in an independent fashion.
Okay. Wait and see.
Yeah, wait and see. I know it's all wait and see.
So for people who don't know, who was Alan Greenspan, and how would you say his style compares to what we're seeing today with Warsh?
Yeah, so Alan Greenspan was the Federal Reserve chair under Reagan, the elder Bush, Clinton, and then into George W. Bush's term in office. So he is a long-running leader of the Federal Reserve, and he's sort of viewed as someone who oversaw a period of relative prosperity in America. his sort of time in office coincided with the sort of tech boom, and also some of the sort of after effects of sort of deregulation, both good in the first instance, in which you saw a lot of economic growth in the sort of latter part of the 80s through sort of the mid and late 90s, and eventually sort of on the downside as well when the subprime mortgage crisis happened. A lot of that was sort of the result of things that happened on Greenspan's watch. But Greenspan casts sort of a long shadow over the Fed. He's the goat of central bankers, if you will, for
the
his
OG.
well, I would say OG would probably be Paul Volcker, who was directly before Greenspan, and he was kind of the heavy hand who squashed inflation in the late 70s, early 80s, sort of kind of the ruthless inflation hawk. And then Greenspan came in, and the period he oversaw was called the Great Moderation. And it sort of was what you want to have happen. You want the economy to be growing, you want inflation to be stable. I think there's a little bit of an open question about how much of this was his own ability to, read and react to economic conditions versus good luck versus a sort of adherence to principles of monetary policy, which is to say, when X happens, you do Y, sort of a paint by numbers approach. I think there is a little bit of all of that, and it kind of creates a sort of, a mystique around his era of central banking. Now, when he started at the central bank, he had some sort of humorous quips about, if you've understood what I've said here today, then I must have misspoke, because the tradition at that point was, central bankers don't say anything at all. But he transformed the sort of image of a central banker of being, someone who occupies a smoke-filled room with, sort of numbers to crunch, to someone who is, facing the public, who has a persona. He was actually friendly with Bill Clinton. I think they played tennis together. So he was a very, very public figure in that respect. So, some of the things he did, even, he started issuing statements about what the policy was. I don't know that was entirely his idea per se, but the Fed did start doing it under him, and they started this process of sort of liberalizing communication that was picked up on by Ben Bernanke. I think it ended up being very useful for him during the sort of crisis years. He was able to use, his ability to communicate directly to markets to increase comfort and calm, but also to make actual changes in how people viewed the long-term trajectory for interest rates. And then sort of subsequent chairs kind of picked up the ball and carried it more in that open communication direction.
And so he kind of spun a nebulous perspective for the world to look at and interpret what the Fed was going to do. Cohn, in your article, talks about how Greenspan's gift was always having a story and knowing when the story stopped working. What does that mean, and how does that tactically unveil itself?
This is an example of describing what is going on in the sort of macroeconomy, which is a pretty difficult thing to do, where you're sort of looking at all the different things going on in the country and around the world even, and trying to squeeze them into not only a decision about how to change policy, but sort of to kind of tell a story. And that may have been one of the kind of critical moments of this was in the sort of mid 90s, when you're having productivity increase. And there was a concern that, the fact the economy is growing so quickly, it's going to lead to inflation. And do you have to sort of step in and shut that down? And, Greenspan was able to, see what was going on and understand it and articulate it. And he made the point that actually, no, listen, if productivity increases alongside this growth in output, you're not going to see higher prices. And so we're going to just hold steady and we're going to let it rip. And they did, and you did not have an inflationary moment, and you did have a lot of growth that, may have been squashed by someone who was a little bit more concerned about inflation in that moment. So that's sort of, telling the story. And then there are moments where things sort of go on a slightly different path. There were a couple currency crises in other parts of the world during Greenspan's tenure, Mexico, and in Asia as well. And so I think obviously those are sort of exogenous factors that have to kind of be factored into how the Fed is going to respond to certain things. And there were moments when, the Fed did change interest rates in anticipation of those events. And then another example of him sort of adjusting the story, but towards the end of his tenure, he was asked about his role in setting up for the subprime mortgage crisis, and he basically admitted that he made the wrong call.
The
And
GFC.
the GFC, which sort of you know. I say the subprime mortgage crisis because the Fed actually has jurisdiction over the mortgage market and from a regulatory perspective, and he kind of made the call at the time
Mhm.
to sort of again leave it alone. He was very much a non-interventionist type. He was a sort of a follower, an actual friend of Ayn Rand, who was sort of a very um, Austrian libertarian thinker. So he made that call, and I think he acknowledged again after the fact that he had not made the right call. And again,
I
that's a
guess,
communication style that I think is valuable.
I mean, in
Yeah.
hindsight, should they have just majorly clamped down on rates and made it not so easy to get
Um.
loans? What do you think Alan Greenspan would have done differently?
Well, I mean, first of all, there are many things that were wrong with how mortgages were being done at the time. The ninja, the no income, no job application, those sort of things, like very much within the realm of like the Fed to have said, hey, listen, you've got to stop this, or, you're going to have to hold a bunch of capital against those sort of mortgages.
Okay, so dumb
Yeah.
question here,
Yeah.
but I'm sure I'm not the only one. Does the Fed have the ability to do that? Can the Fed
Mm.
say, make these changes now? Or do they need to kind of do a quid pro quo approach where they say, if you don't do these changes, then we're going to change the rate landscape?
Yeah. So along with setting monetary policy, the Fed, they supervise banks, they regulate banks, so they have those powers as well. And so the Fed, they supervise
Okay.
every
It's a big
bank.
albatross hanging around
Yeah,
his neck big
yeah,
time.
yeah, yes,
Oh
yeah,
my
yeah. They
gosh.
had direct
Yeah.
direct
Okay.
control. Yes, yeah.
Okay. Well, shoot. So we had a really good run of things working very well. The Reagan era, which I think the general sentiments are positive about that
Mm-hmm.
time. And
Mm-hmm.
then you've got the rise of the internet and, I
Yep.
mean, of course, the dot-com boom and crash, but
Yep.
he presided over a pretty good run.
Yeah. I mean, I don't think you can really question the outcome of that era. I think the long tail of it. I think we're going to be sort of dissecting that for a while, and you're going to have people who are going to say, look, in some respects unavoidable. You got all this growth because of deregulation and because of this sort of laissez-faire approach.
Mhm.
And so, you need to, with one comes the other. And then you're also going to have people who would say there's a recklessness about it. And, I mean, I leave that to the historians
I wonder
to
if,
finalize.
yeah, that's fair. I wonder if he suspected that, hey, look, this is crazy what's happening right now. And we're giving these guys enough rope to kind of hang themselves, to use a
Yeah.
dark analogy.
Yeah. Yeah.
Uh, I suspect he probably knew that was the dynamic. I wonder if he didn't anticipate the bailout dynamic. I wonder if he thought this would be a culling, but it actually turned into a massive bailout, which, as we know, this was interesting to me when I learned this. It actually generated a lot of revenue for the federal government, the TARP
Yeah.
bailouts.
Yes. Yeah.
But I wonder if that was a piece that just surprised him and was maybe part of his strategy here.
Yeah, I think that,
We're just guessing here, but
yeah, we're all guessing, but I mean, I think it was probably foreseeable that there would be some issues from this, but I think the contagion factor exceeded all expectations. And you have this sort of credit crunch, you have the failure of banks that obviously caught a lot of people off guard. And you have the sort of some of
yeah.
these innovative products, um, you know, both on the securities front and on the insurance front as well, and the sort of the intersection between them. I mean, hindsight is 2020, and now you can see that and say, oh yeah, like this is an accident waiting to happen. But at the time, they probably assumed a lower worst case scenario.
Yeah, fair enough. Last question for you. Let's say that you're at a dive bar with your
Mm,
buddies and sitting on the bar stool next to you is Warsh. You've got 30
mhm,
seconds with him
mm.
off the record. What do you want to ask this guy?
Yeah, that's a great question. Sadly, I would probably ask him for his thoughts on bank regulation, because I know that no one else is going to ask him about that. But if I were to take off my American banker hat and put on, maybe more of a general news hat, I would ask him to talk me through his views on AI and why he feels the way he does about AI, which is the recent past. He's talked a lot about it being a productivity driver, again, like we saw in the 90s, where this can really help with inflation, can help with budget deficit. Boom in productivity is sort of cures all ailments from a macroeconomy perspective. So I would like to unpack his thinking on that a little bit more and try to understand why he feels so confident that it's going to have the results that he has said they will have over the time horizon that he has said they will have. So I'd like to get his thoughts a little bit more in depth on that and maybe get them a little more unvarnished if possible.
Okay. Awesome.
Yeah.
I mean, hey, that's a very interesting topic, and maybe we'll get him on the podcast and he'll spill the beans for us.
Yes, fingers crossed.
Well, hey, thanks so much for being on the show.
Of course.
Why don't you tell us a little bit about your beat, what people can expect to see you produce, and where they can follow your work?
Yeah, so I cover the Fed for American Banker. I cover bank regulation more broadly, and I guess increasingly I'm taking a look at various types of emerging risks in the financial system and the sort of various forms that those take. Sort of both related to banks directly and indirectly. And this covers AI, covers sort of the crypto space. So I'll be very active in all those sort of emerging areas, and again, with an angle of what it means for banks. But I think if you read my work, you'll hopefully walk away with an understanding and appreciation for how banks sort of shape not only the financial system and sort of the business environment, but also the way we live here in the U.S. So if that sounds interesting, American Banker is where you can find me.